My name is Donte'Ja Barnes, and today me and my group, we're going to be presenting Hewlett-Packard's Enterprise's 5-year strategic roadmap.
Hi, I'm Tony Rogers.
And I am Ivan Cameron.
Okay, so we're going to begin starting by just presenting an executive overview. So Hewlett-Packard Enterprises, also known as HPE or HP, is a global technology leader providing edge-to-cloud solutions for businesses and governments worldwide. So the core business segments are compute and storage, intelligent edge, financial services, and high-performance computing. The market served are enterprise, public sector, and cloud service providers across global regions. The project goal is to develop a 5-year roadmap to strengthen HP's global competitive advantage and financial performance, which you will be seeing us present throughout the presentation. So the base year we're focusing on is right now, 2025, and the projection year is going to be a 4-year span from 2026 to 2030. So the industry and competitive landscape, focusing on key industry trends include cloud computing, artificial intelligence, also known as AI, edge computing, combining on-premise and cloud technologies, and cybersecurity. So when it comes to cloud computing, infrastructure and modernization is being driven by the quick transition to hybrid and multi-cloud models. With AI, this is a growing need for infrastructure prepared for AI and data-driven decision making. Edge computing includes growing demand for near source real-time data. Processing is essential for IoT and 5G. Combining on-premise and cloud technologies is for scalability, cost-effectiveness, and flexibility is known as hybrid IT also. Cybersecurity is going to be a growing focus on safe cloud settings and end-to-end data protection. So now we're going to discuss the main competitors of HP. So its competitors include Dell Technologies, Cisco Systems, IBM, and Amazon Web Services. With Dell Technologies, this is a competitor because of their strong storage, servers, and cloud infrastructure integration. With Cisco Systems, they are the leader in networking and cybersecurity with expanding hybrid cloud capabilities. IBM is focused on hybrid cloud and AI, leveraging strong enterprise relationships. And lastly, with Amazon Web Services, they are dominant. They are a dominant cloud service provider, expanding into edge and hybrid IT. So going on, discussing their challenges and opportunities. The opportunities relate back to our last slide a little, but first discussing the challenges. They have a fierce rivalry in the markets for edge and cloud computing. It has uncertainty in the economy and growing operating expenses and ongoing talent shortages in AI and cybersecurity. Its opportunities include accelerating industry-wide digital transformation, increasing funding for energy efficient data centers and green technologies, and growing need in emerging markets for secure hybrid solutions powered by AI.
Thank you, Donte'Ja. Now, current Hewlett-Packard Enterprises performance based off the year 2025. If you take a look at the left side, Q1, fiscal year 2025, the revenue approximately for the U.S. was 7.9 billion, and that is up 16% year over year. Next, we have Q2 of fiscal year 2025. Revenue approximately in the U.S. 7.6 billion. And that next bullet point, 6 months ended in April 30th, 2025, and the net revenue approximately was in the US 15.5 billion with a gross margin of 28.8%. Now on the right side, we have the Q3 fiscal year 2025 results overview, which gives you an example of what the projections may look like moving forward. Donte'Ja, can you go to the next stage, please? Now, looking at our revenue for the base year of 2025, and this here is financial estimates. For the full year of 2025 guidance, revenue growth in constant currency estimated 7% to 11%. Non-GAAP diluted net EPS estimate, US 1.7 or 70, and then 1.90 or 190. for fiscal year 25. Profitability headwinds, gap margins forecast to decline. The cost reduction program underway. So it's targeting in the U.S. 350 million savings by fiscal year 2027, which is a good thing. Donte'Ja, next slide, please. Now, our current strengths and weaknesses in 2025. For strengths, our strong growth and momentum in high growing categories such as the server segment, which saw double-digit growth in Q1 to 29%. And then next, we've seen quickening the shift to a as a service and hybrid edge models, which is in line with significant market trends and global reach in a variety of industry sectors, including financial services, intelligent edge, storage, and hybrid cloud, provide market resiliency for Hewlett Packard. As far as weaknesses, margin pressure in Q2, the gross margin fell to about 28.4%, down about 4 percentage points from the previous year. Operations and free cash flow issues, such as reported negative free cash flow for specific time period. Execution risks, restructuring, and cost-cutting initiatives are under progress. Macro headwinds include competition and tariff effects. Certain measures show a modest or negative profit growth estimate. GAAP operating profit growth anticipated negative. Next slide. As far as strategic vision for the next 4 years going into 2026 and 2030, our vision is to be the global leader in hybrid cloud edge to cloud intelligence and sustainable IT solutions is our vision. As far as strategic objectives, extend high profit cloud services, enhance our portfolio of edge computing and AI, boost the effectiveness of operations, expand sources of recurring income, keep the money flowing, and then promote ESG leadership and sustainability. Thank you.
All right. The strategic insights from 2025 to 2030. For financial strength, HPE remains profitable with expanding margins, efficiency, the SG&A reductions and automation drives 2 to 3 point margin gains. Innovation increases research and development to approximately 9% of revenue to compete with AI and cloud. Shareholder value, EPS, and return on investment trends signal long-term sustainability. Risk factors, hardware margin pressure, and integration of Juniper. Our goal is to lift the return on investment to 6 to 8% and sustain less than 10% net margin by 2030. Next slide, please. Our strategic recommendations would be to boost the research and development investment by 5% annually, optimize capital structure post-acquisition, and grow GreenLake subscriptions to 40% by 2030. Also, deepen AI hardware partnerships and foster a culture of continuous innovation. Implementation timeline. In 2026, the Juniper integration, we're going to work on making that as efficient as possible and making sure that the merger goes how it needs to. In 2027, the AI cloud expansion, we're going to work on figuring out how we can do better on that and figure out how we can improve our AI and be the best in our industry. In 2028, global scaling. We're gonna have more home offices in different countries. And in 2029, we're gonna look into a better automation phase so that we won't have to have too much labor. And in 2030, industry leadership with an 18% operating margin, where we want to be the leader of our industry in 2030. That's the goal. The financial overview of 2024, the ratios. The total revenue was 30,127,000. Gross profit was 10,373,000 with a 34.4 margin. Operating income was 2,190,000 with a 7.3% rate. Net income was 2,550,000 54,000 with an 8.5% rate. Research and development rate was 7.5%. The SG&A intensity rate was 16.2%, and the effective tax rate was 12.7%. All of this shows that we had solid profitability and the rebound post restructuring from the acquisition. It also shows that we're improving our operational efficiency. Also, it shows that we have opportunity in hiring our software and service margins. These are the key financial equations I use to get all of those ratios and for the further ratios and projections in the next few slides. Okay, the financial overview of the ratios. The gross margin was at a 34.4% in 2024, showing that we're improving on our strong cost management. Operating margins were 7.3%, which was rising, which shows that we're gaining efficiently. Net margin was 8.5%. This shows that we have solid profit stability. Research and development of revenue was 7.5%. This is steady, showing that we have good return on our investments for innovation. The SG&A rate of revenue was 16.2%, which is stable, showing that we could do better in optimization. The effective tax rate was 12.7%, which lowered, showing good tax efficiency. And the EPS growth rate on the 2-year CAGR rate was 63.6%, showing strong increase in the shareholder returns. All right, the revenue and profit growth from 2025 to 2030. So assuming 5% annual revenue growth and margin improvements, in 2025, the revenue should be around 31.6 billion and should raise to 40.4 billion in 2030, assuming 5% annual revenue growth. And then the net income in 2025 is 2.75 billion and should raise to 4.04 billion in 2030, assuming, the 5% annual revenue growth. With this, net income should double by 2030, since the Juniper deal. This should show strong signs of sustained profitability. And as you see right here, I had put a graph in just for, moderate growth. So for the 5-year projection, it was a 12% growth rate for our revenue as a moderate growth, and then 12% net income growth, and that's the moderate. You see that that's going in a constant slope up, so that shows that it's moderately going up. That was the low end where our goal is in our projection. And for our high end, for a more aggressive approach, we put the revenue growth for a 14% and the net income growth for a 14%, showing a more steep incline, showing a more aggressive rate. All right, margin expansion and cost efficiency. Our operating margin in 2024 was 7.3%. So in 2030, we want it to be no more than 10%. And our net margin in 2024 was 8.5%. We want this to go to 10%. This indicates improved cost control and a higher value in our service mix, and continued SG&A optimization is needed. Return metrics, our efficiency analysis. Our 2024 baseline, our return on investments was 4.2%. Our return on assets was 4.2%, and our return on equity was 12.8%. In 2030, our projection for return on investments after the Juniper deal should be 5.